Hello guys, welcome to SMC trading course. Hope you all doing great. In this video, I'm going to discuss setting limits, stop loss and take profit levels. So when you're going to take either long or short position, this is a general question that arises in your mind that how would you place your limits and where to place your stop losses and how to book partials. That is 40%, 60%, 80%, or you may say your full profits as the trade plays out. So for a bullish market, when you see these, that the price comes to this order block and shoots up, and you identify that there is an order block here, what most people do is that put the limits here, putting stop loss here, take profit levels here. But there are a few points which you must keep in mind while placing your limits. That is, when you mark this order block, you must place your limits at a psychological price. But you don't consider the psychological price. You might see this, for example, we are considering this as price to be 244. Sometimes what happens is that the price comes down, nearly hits this price, did not activate your limits here, and then the price shoots up. So why does this happen for most of the times? Because when the price comes down, there are many institutions or big banks who place their limits up here. And what do they do? They are going to buy this stock at a psychological price. For most of the cases, they're not going to buy it at 244. Here might be a price which is 245. So what the institutions are going to do is that they are going to place huge amount of buy limits here, and then when the price comes down here, the buy limit orders get activated and then the price shoots up. So what you should keep in mind is that at a very psychological price. So whenever you see this order block up here, what you do is you place your limit at 245 instead of 244, or you may say that you place your limits at 245.1 so that you don't miss the entry. So the best price to set your buy limit order is 245.1 so that even if the price comes down, it doesn't miss your entry. Same is the case for a bearish market. Then the price comes down, moves back up, comes down, moves back up to this order block and then shoots down. What you do is that when you see this order block, suppose here the price is 246 and just below it the price is 245. So what you do is that you place your limits here, putting stop loss out of this order block and setting your take profit levels here. So what you do as a trader, the best limit order is that you don't just put your sell order limits at 245. Instead, the best price is below 245, that is 244.9, so that the price might move to this level and rapidly shoots down. So 244.9 creates more chances that the sell limit order gets activated. Now moving on to the stop loss level. You must keep this in mind that for Indian markets, this order block doesn't get respected just as the Forex market. So for most of the cases, what happens is that the price moves up, comes down, moves up, comes down, and it nearly touches your stop loss and then shoots up again. If this is your order block here, what you do in Indian market is that you place your limits here, but you don't keep your stop loss so tight. What you do is that you leave some space for your stop loss. Same is the case for sell order. whenever you see order block here, you don't place your stop loss too tight. Instead, you give some space for this order block. And now coming on to the take profit levels. So these are the important factors which determine your different take profit levels. The first one, you may say supply or demand zone. Next comes, if you see, liquidity, and next comes, if you see, imbalance. So now I'm going to show you how these factors are important to determine your take profit levels. Firstly, I'm considering it for a bullish market. Suppose you see that the price moves up like this. What happens is that the price retraces back and creates liquidity up here. You could see that there is double top and there is liquidity up here. And then the price retraces back to this order block and then shoots up again. So whenever the price comes to this order block here, you could see that there is liquidity up here and there is liquidity down here too. So what does the price do? The price clears the sell side liquidity up here and then shoots up. So as you see liquidity here and you know that the price is going to grab this liquidity, for most of the cases when you see order block here, you place a stop loss below this order block, putting your take profit levels above this high because you know that the price is going to break this high. But when there is no such solid move in the market or no such solid trend in the market, what you can do is that when you see these levels of liquidity, you know that the price is going to grab this liquidity up here. So you might take your full profit here, but what you do initially is that you take most of your positions up here, because there is a chance that the price moves up like this, did not reach your take profit levels, and then hits a stop loss. Because as I said, when there is no such solid move in the market, and when you could see that the price is consolidating here for a bit, and there is no such clear break of structure to the upside, but there is a valid order block here, and the price comes down here, and the price is going to shoot up, then you should book most of your position here. You may say 70-80% here, and put your stop loss to break even and take profit levels here. So this is how the liquidity factor helps in determining your important take profit level. And next I'm going to show you a supply or demand zone. Suppose it may happen that the price is moving up like this, shoots up rapidly. But while it comes down, it is coming down, creating liquidity here, and then it comes back to this unmitigated order block, and then it's shooting up. You could see that the price has created liquidity here, another levels of liquidity here, and there is a valid supply order block here. And what the price do is that the price retraced back to this demand order block, and then the price is shooting up. But as the price is shooting up, you see that there is a valid supply order block here. If your trade has already played out well and it's a good 1:5 risk-reward ratio trade, and there is a valid supply zone up here, what the price might do is that the price shot up, then hits a stop loss, and then shot up again. So whenever you see a valid supply zone here, what you do is that you book most of your position up here, setting stop loss to break even. Whenever I say set SL to BE, that means set stop loss to break even. That is, there is no stop loss up here. It's a risk-free trade. So for this trade, what you might do is that you see that the liquidity is here. So you might book 60% of the positions here, and since there is a supply zone up here, you could book 80% of your positions here, and then the remaining positions here. This is how you determine your take profit levels. And next we come to imbalance. There is a law in imbalance which I've already told you, that the price is going to fill the imbalance. So now how this imbalance is going to determine our take profit levels, I'm going to show you. Suppose This is a bullish market. The price created some amounts of liquidity up here, and then the price shot down, and then the price is shooting up. So you see a valid order block here. The price is reacting from this order block, and here you see that there is imbalance. So as you see imbalance up here and a valid supply block, you may say here. So this imbalance gives you a confluence that the price is going to fill this imbalance up to this supply block. So what you do as a trader is that since you know that there is imbalance to be filled, you take your buy limits here, putting take profit levels up here, because you know that this imbalance is going to be filled. Sometimes what happens is that you see that the price is moving up. There is a valid order block up here, and whenever you see that there is very less imbalance up here, very less imbalance. So I'm considering it as a negligible imbalance. But here you see lots of imbalance and a supply order block here. So whenever you see these type of structures, what you do is that you put your positions here, putting stop loss below this order block. And whenever you see that there is a lot of imbalance up here and there is negligible amount of imbalance up here, then you know that the price is going to come back to this supply block here. So you take most of your positions here. Instead of targeting your full take profit levels here, what you do as a trader is that you take most of your positions up here, because there is always a risk that the price moves up, did not fill this imbalance, and then the price hits a stop loss and then shoots up again. So what you do as a trader, you take your full positions here, but what you do is that you take most of your positions here. You may say 80% of your positions here, and then 100% of your position here. So this is it. This is how you place your limits, stop loss, and take profit levels. And now I'm going to show you how you place your stop loss and take profit levels at important price. So you might see that the price here at the order block might be 240, and there is a high chance that the price comes back to 240 and shoots up. But what happens for most of the cases is that the price moves slightly down because all of the orders did not get activated and then shoots up again. So the ideal stop loss price is not 240. Whenever you see that the price is 240 or at important psychological price, what you do while placing buy limits is that you place your stop loss just below this psychological price. That is, you may say at 249. Sorry, 239. Same is the case for take profit levels. Sometimes it might happen that the price did not hit your take profit levels while pressing your buy limits here. I'm considering the fact that your take profit level here is 300. So what you do as a trader while placing buy limit is that you place your take profit levels slightly below this buy limit. That is at 299. Same is the case for sell orders here. While placing your stop loss here in sell limits, you place slightly above the psychological price and slightly above the take profit levels. If here the price is 200, suppose I'm considering the fact that here the price is 200. But what you do as a trader while placing your sell limit is that you place your take profit levels at 199. Putting your take profit level slightly up. Suppose the stop loss here at the order block is 260. And what you do as a trader while placing your stop loss, place slightly up. Sorry. Here at the order block, the price is 260. And what you do as a trader, place your stop loss slightly above the psychological price, that is at 261. So this is how you should place your limits, stop losses, take profit levels. Here we come to another important tool which is used while placing limit, is the gun box. That is this tool. Sometimes what happens is that the order block is very big, and for those cases what you do is that you take major position here, putting stop loss down here for buy orders, and take profit levels here. Suppose you see and your partial position at this price, putting stop loss below this order block, taking profit levels up here for buy limits. And when you place these orders, you place these limits at a psychological price and putting your take profit levels up here and stop loss slightly below it. Now I'm going to show you one example how the psychological price is very important, and when you see these big order blocks, how you place your trades. Now moving on to the charts. This is JSL. This is the trade that I've already shared. You could see that this is a very important order block because this order block cleared the liquidity down here, and after this order block the price shot up rapidly, creating imbalances here. And what it did is that it created liquidity here, inducement here, and you could see that I have two positions because this order block is very big. And what I did is that I put my limits here, putting stop loss below this order block. I placed my limits at 255.05. So you could understand why I put 0.5 and why I put 255. I could easily put my positions at 253.95 or 254. But what I did is that I put my position at 255 because 255 is an important psychological price than 254. So this is how a psychological price is important. And whenever you find the order block is so big, you could use this gun box as a tool to mark your 50% and take major positions here. So this is it. So this is how you must use your limits, that is buy limit or sell limit, put your stop loss and take profit levels. This is the end of this session, and now moving on to the next session.